and new products in the US drive sales back to normal levels. Longer term, beginning in Japan, with the third sector almost fully penetrated, sales in the country should remain relatively stagnant. On a more positive note, however, looking at the US, we are encouraged by Aflac's expansion into new markets such as network dental and vision and group benefits with the recent Zurich acquisition, which we believe shows that management is making expanding market share a priority. However, with the depression in sales in the short term, it may take longer for Aflac and its investors to fully assess the return from new acquisitions and expansion into new insurance lines. Finally, with slowing net income due to the previously mentioned effects on Aflac's bottom line, we expect share repurchases to be an extremely important driver of Aflac's future returns. In our model, we projected Aflac to repurchase shares at the same 8.7 million share per quarter rate seen in 2020, up to the limit currently authorized to be repurchased by Aflac's board of directors. With this, we projected net income to grow at a 3.5% CAGR till 2025. However, EPS was projected to grow at double this at a 7% CAGR, illustrating the potential returns created by share repurchases. Now turning to valuation. We use two relative and two intrinsic valuation methods to arrive at a final price target of $42 per share. To give an overview of our methodology, we used a cost of equity of 5.84% as our discount rate, which we arrived at using a beta of 0.85, which was calculated by averaging the 5-year monthly regression beta with the Bloomberg regression beta pulled over the same time frame. In order to adjust for the short-term effects of COVID on volatility, we blended both methods with the respective beta at the end of trading in January 2020. Our terminal growth rate was found by averaging long-term inflation and GDP growth forecasts for both Japan and the US, while weighting Japan at 60% and the US at 40%. Our first method was a standard comparable company analysis using blended forward price to earnings and latest filing price to book value. Our comparables are listed on the left, which were selected for their exposure to the same or similar lines of insurance as Aflac, as well as similar returns on equity and capital structures. Using the median metrics of this comp set and applying them to Aflac, we returned an implied share price of $40.90. This was weighted at 35% due to a belief that Aflac's future returns will be closely tied to this group of 7 companies. To finish up relative valuation, we created a return on equity price to book value regression model using data from 19 other medical and life insurance companies. After applying Aflac's book value of equity to the resulting equation, we returned a price target of $48.52. While we are satisfied with the R-square value given by the model, the remaining error prompted us to weight this method at 15%. To start intrinsic valuation, the bulk of our weighting comes from our dividend discount model, which yielded a price target of $41.05. We projected all dividends and discounted them on a quarterly basis, meaning the above numbers represent the sum of each year. Also, it should be noted that dividends were calculated on a per share basis to account for the effect of share buyback. Our 2021 projection was found by annualizing the declared dividend of 33 cents per share, with 2022 using a payout ratio equivalent to the adjusted 5-year average. For all subsequent years, this payout ratio was then boosted by 1% annually to account for slowing net income growth and Aflac's room to expand its dividend payout, considering its strong balance sheet and modest ratio relative to its peers. We weighted this method at 35% due to our belief that dividends will drive the bulk of shareholder returns. Our final method and second intrinsic valuation method was a residual income model, which we used in place of a standard DCF because of the differences in capital usage between financial and real sector companies. Our equity charges to book value each quarter were calculated using our previously mentioned cost of equity. Overall, we yielded a price target of $43.55, which we weighted at 15% due to our belief that dividends rather than residual income will drive future returns. And with that, I will pass it on to Billy for the risk.
Thank you, William. I'll now expand on 2 pertinent risks we identified from our report. Risk number 1, sales declines provide a short and long-term risk. On the short-term side, Aflac has experienced sales declines from COVID, preventing in-person sales. On top of this, the non-essential nature of life and cancer insurance leads to struggling consumers putting off purchasing supplemental insurance until a later date. Aflac's high concentration to the Japanese insurance market leaves them susceptible to the general Japanese market and demographics in the long term. Japan has an aging and declining population base and mature economy. And while Aflac has a strong moat brought on from their branding, their dominance in the space could be jeopardized by weak demographics or a weak Japanese economy more so than peers. Second, risk number 2, technology provides either an opportunity or threat to Aflac. As we have seen in the past years, technology has gained prominence across all sectors. We believe that technology will determine the company's long-term success. COVID has accelerated trends and Aflac needs to take advantage of them. Currently, Aflac has made minimal investment resulting in single-digit sales attributable to online. Many of Aflac's competitors, such as Prudential and MetLife, have made acquisitions within the tech space, and so Aflac currently lags peers. We will expand on other risks in our appendix. Looking at ESG, we're going to focus on major initiatives and how they pair against competitors. Aflac has a variety of environmental initiatives that they have put in place. They have ISO certifications for energy and environment management and a 2040 carbon neutral goal compared to peers. Compared to peers, we want to see Aflac have more aggressive plans. MetLife achieved carbon neutral status in 2016, and many competitors are on quicker timelines. Aflac is only 10 years ahead of the United States with their carbon neutral goal. Aflac has several social initiatives in place to increase diversity within the workforce, as well as social causes. We want to see higher women representation in management positions, especially in Japan, as there's a serious lack as you move up the chain. One large attractor is a relationship with external partners. Being connected to less socially minded companies hurts Aflac. Japan Post Group scandal is a great example of a company that is extremely involved in Aflac, but which harms their social impact. Finally, looking at governance, Aflac is on par with peers, if not slightly behind. As you can see, the board composition could be more representative, and their CEO pay ratio is higher than peers. 96% of shareholders voted in favor of their current CEO and NEO compensation mix, though, and we like that mix as well. One important point is that their founder is the son and nephew of the co-founders. We believe that Dan Amos has been successful, though, and that his election to CEO was over 30 years ago, and thusly the governance impact is minimal. Overall, their creation of aflac.esg.com and other reporting methods makes us believe that they are focused on improving ESG policies. We believe that their ESG efforts are currently behind peers, showcased through third party in our own analysis.
In conclusion, we want to reiterate our hold rating. We believe that Aflac will continue to generate consistent returns in line with the market long term, but expect current unfavorable market dynamics to cap short-term returns. And with that, we are ready to move into Q&A.
All right, time has expired. Thank you, team. Great presentation.
Thank you.
We will now turn it over to the judges panel for a Q&A. I will also give the judges a 1-minute warning when we get there. So judges, please go ahead.
Could you remind me about the share repurchase? What were your assumptions on share repurchase?
So we projected share repurchases at the same rate that have been seen in Q&A up to a report publication. So 8.7 million shares repurchased per quarter. So we did that, and we repurchased shares in our model at our target price per share, just to avoid any unnecessary speculation. And we didn't want to speculate on how much the board would allow to be repurchased over what's currently authorized. So we only in our model, we only repurchase shares up to the limit currently allowed.
Thank you.
I have a couple questions. So I know that Japan has a demographic issue, but in the US and places like China, where you've seen that besides just the numbers, that the younger, millennials and Gen Z have much different purchasing patterns and habits and thoughts on personal finance than older generations. Did you look at that at all? Or is it an issue in this space?
Yes, so the younger generation definitely has a digital preference. There's a 48% consumer preference for digital capabilities, and Aflac is only has their digital sales as to 2 to 3% of their total sales. So we do see the increasing technology preference as a risk to Aflac.
Okay, and what about, are the younger generations concerned? Are they concerned about insurance, or can you tell?
So we do know that the working age population is generally the demographic age to where they are going to be their first-term buyers for Aflac. So that's going to be where their new sales come from. And in Japan, if we want to go to slide 34, Billy, to talk about the Japanese trends, we can see the total age, the working age population is expected to decrease by nearly 10% by 2028. And then the elderly population is set to increase by 12.4%. So we're seeing a decrease in the addressable market for the sale of their new policies.
Great, thank you. And then my last question, have they talked any about succession planning? Because I guess the CEO is close to 67, 68 now.
Listening to their last earnings call and kind of latest news from them, they have not.
Okay. Great, thank you.
So you had a slide up there, I think it was on your one of your valuation slides, where you looked at projected GDP growth in the US and Japan. And I was wondering regarding the Japanese GDP growth, is that basically a post-COVID rebound number, or is that an estimate for ongoing GDP growth? And where did that number come from?
So it came from OECD forecasts. So this would have been long-term 40-year forecasts. And I pulled that from their January publication of that. So that would have taken COVID into account at that point.
Okay, but that's expected to be a recurring estimate?
Yeah, and on average into perpetuity estimate. Yeah.
Thanks.
I just have a question on the valuation methodologies you used. Do you have
Sure.
a summary sheet? And I may have missed this at the start. Do you have a summary sheet on the prices you arrived at for each valuation, and then sort of the weightings? And would you just walk us through, oh, thank you. Would you walk us through why you chose those weightings?
Yeah, definitely. So I really wanted to keep it around 50-50 intrinsic relative valuation. So with that, I thought that with the ROE price to book regression model and the residual income model, the predictive power of those were a little bit more than just a 10% weighting each. So 40-10 didn't make quite sense to me because then it didn't really have as much of an impact on the overall price target that I think that their predictive power showed. However, I felt that 30-20 was a little bit too 50-50. And with the predictive power of the comparable company analysis and dividend discount model being high in our opinion, we wanted to sort of keep it a little bit more onto the weighted towards those two methods. So we felt that 35-15 was a good midpoint between those, and it made sense for us.
Thank you.
I also have a couple of questions. So the first question I got is Aflac diversifying the types of insurance that they're offering to the consumers? Are they, thinking about moving into any other kinds of insurance?
I can go ahead and take this question. So if we want to go to slide 31 and look at the product breakdown. So here you can see that this is their Japanese product breakdown. So they have cancer products, other accident health products, and life insurance products. And another thing that they're doing in the US is that they're offering dental and vision through their new acquisition of Argus Holdings. So they are offering new products in both Japan and the United States.
Okay, what about, let's say, pet insurance or something like that?
Yeah, so they do have a partnership with Trupanion, and that is for pet insurance. As of right now, we see that as a relatively small investment, and we don't see that as being a huge factor into their growth, but we do think that that has room to grow.
Okay. And one more question. So they have Japanese exposure. Do they do anything about the foreign exchange exposure that they have? I'm sorry, I can't hear you. You're probably muted.
If we want to go to slide 57, Billy. So this is the exchange rate between the US dollar and the Japanese yen. And so you can see as the yen strengthens, they're going to have more dollars as a result. And so a stronger yen is going to magnify the current period in comparison to the prior period. But I think it is also important to note that a significant portion of Aflac's earnings are never converted into dollars, and they're only translated for GAAP reports.
Okay. Thank you.
I have a question. Did you make any specific adjustments for the differences between the guideline comparable companies that you used and Aflac? How comparable were they, in your opinion?
So we felt they were very comparable. I try to really keep it around the same ROE and the same, just Billy, could you go to comparable? Yes. So we wanted to keep it around the same ROE and same market caps, and also try to get as many of Aflac's direct competitors in Japan and the US as possible. So it was really with MetLife and Manulife. We think that those are the two closest comps. But with that, the reason we included the ROE price regression model with the comparable company analysis was to sort of account for the fact that their ROE is slightly above their peers. So the reason that that price target was a little bit higher than their comps was for that reason. And we felt that weighting that in with the comparable company analysis took that into account and resulted in a more accurate relative valuation. And that was sort of why we blended those two methods.
Thank you.
One last question. Did you look at, did you quantify any sort of interest rate shocks on their investment portfolio?
So we assume lower for longer rates. And just with the recent announcements with the Fed and the BOJ, especially this week, even with the spike in yields suggesting lower for longer rates, and even with Japan, with the BOJ coming out and saying that future rate cuts, are potentially, in line or still a potential, just because deflation is still a risk. What we did is we looked at the change in their investment returns from Japan and the US over the past few years, taking into account the change in interest rates. And we found an average for an average decrease in Japan for their fixed income portfolio, which was around a negative 0.006% per quarter change. And then we applied that over our projection period. And then in the U.S., we kept the investment returns flat, assuming the similar rate environment. And we felt that it was sort of offset by the various macro factors that are affecting us now. And just with the Fed's comments, especially in the past month, we felt that that was appropriate, that we shouldn't take into account any interest rate hikes between now and the end of our projection period around 2023, 2024.
Thank you.
Yep.
Did you see any disruptors coming from a insurance kind of fintech, other types of disruptors coming in?
We didn't find any specifically comparable companies on the tech side. Looking deeper into tech, we do see it as a very important factor for the company, though. At a general level, you see companies like Lemonade and other insurtech companies kind of breaking into the space. However, they're not in Aflac's end markets yet. And so we see them having, this is why it's kind of a longer term risk. In the long term, we see it potentially being a large factor, but at the short term, we don't see too many companies breaking into their specific space yet.
I guess if you're a big enough company like Aflac, you can buy a young competitor who's coming up with a.
One point to note on that is that kind of through our analysis, we realized that we kind of see Aflac as a kind of slower moving company within the space, and they're not one to make large acquisitions mentioned in their FAB briefing. And so we do see that. That's kind of why it's one of our largest risks. We don't necessarily see them making an acquisition within the space like competitors. And so that's why we kind of see that as a larger risk to them.
All right. Thank you, judges. Now we'll conclude the Q&A.
Awesome. Thanks, everyone.
Really great to hear that presentation.
Thank you.
Thank you so
Thank
much.
you, guys.
So now we will break out the judges, and we will compile the scores, and then we will have the next team present in about 10 minutes. So congratulations again. Thank you.
Thank you.
All right, Team C, congratulations on making the finals. We're glad to have you here and look forward to your presentation. We will give you 10 minutes to present. I will give you a 1 minute remaining audio reminder, and then we'll pivot immediately into a 10-minute Q&A from the judges panel. So is your team ready to go?
Yes, we are, Hunter. Thank you.
All right, we'll have a great presentation. Good luck, and your time begins now.
Thank you.
Yeah, once you get going.
Good morning, everybody. We are Team C, C for Champions. We are issuing a hold recommendation for Aflac Inc. based on 4 key points. 1, its current price intersects our target range. 2, we're upbeat on Aflac's long-term growth prospects. 3, an attractive dividend yield and share buyback program. And 4, near-term headwinds such as revenue weakness. Our target range is $45 to $52, yielding a hold recommendation, and it was derived on the below 6 valuation methods. We're going to dive into this investment thesis, but first, a brief overview of Aflac's business mix.
Aflac is split into two main operating segments, Japan and the United States. The United States comprises of 29% of its pre-tax income and Japan 71%. Japan operates within the first and third sector, with the third comprising of 91% of Japanese segment operations. The next slide showcases Aflac's competitive advantage in Japanese cancer insurance and within the US accident and disability. From the graphs on the right, you will notice that Aflac leads its competitors in Japan's third sector market and the US's voluntary benefits market. I will now pass it off for valuation.
We valued Aflac using a blended approach consisting of the residual income model, dividend discount model, and public comparables, and arrived at a target price of $47.80, representing roughly a 0.5% downside from its last close price. Our team did not use the DCF method because cash flow is too unreliable to generate an accurate target price for insurance companies. This is due to the influence of the investment portfolio and resulting cash flows on the cash flow statement. We want to note that Aflac is forecasted to trade at a premium in relation to our comparables, who consist of Prudential, MetLife, and Manulife. The next slide shows that although our regression implies that Aflac is marginally undervalued compared to global life insurers, the graph on the right illustrates that while historically Aflac has been an outperformer, since COVID, Aflac has only outperformed the insurance sector, but has underperformed the market as a whole, supporting our hold recommendation. The next slide illustrates that over 72% of our Monte Carlo simulations produce a price within our valuation price range derived from our blended valuation approach. The alpha values of Aflac using the FAMA and French 3 and 5 factor models, as well as CAPM, are statistically insignificant, supporting our neutral valuation and hold recommendation. I would like to now hand it off to our industry expert.
Our second key point in our recommendation is Aflac's strong long-term growth potential. In the past 2 to 3 years alone, Aflac has undergone several strategic bolt-on acquisitions, giving it a foothold in markets such as pet insurance, group benefits, and dental and vision. In the long term, Aflac is interested in penetrating the rapidly growing emerging Southeast Asia markets. However, as the company has no tangible plans to do so in the next 5 years, it would be imprudent to price this into our current valuation. Notice on the right-hand side that Japan's population is projected to continue aging for the next several decades. The bottom right illustrates that this is conducive to demand for third sector insurance, such as cancer insurance. The demand for cancer insurance has doubled in the past 18 years alone and is projected to continue doing so in tandem with the aging population. Aflac has recently launched a slew of new initiatives aimed at penetrating new US markets. The bottom left clearly demonstrate that Aflac has tremendous potential to grow within the US. However, in our view, this will be largely offset by the rapidly increasing competition in US markets. Additionally, Aflac's long-term growth in the US is supported by demographic trends such as a workforce that is younger, cash-strapped, and digital savvy, and is demanding digital and portable insurance solutions. In addition to the continued prevalence of high-deductible healthcare plans, we will now discuss financial analysis.
We will now talk about Aflac's historical and expected future strong capital deployment while facing near-term headwinds. Aflac has provided value to its shareholders by increasing its annual dividend per share for 38 consecutive years. We expect Aflac to increase its dividend per share in the future due to the company's ability to defend against the pandemic and their long-term outlook on profitability and growth. Additionally, Aflac provides a strong dividend yield that has averaged 2.3% since 2015. Furthermore, by shares repurchases, management believes the stock is undervalued in the market. Next, as you can see on the next slide, Aflac has increased its capital deployment through repurchases, dividends, and growth investment opportunities. Future looking, we expect Aflac to increase deployment from 2020 to 2022. Aflac is able to deploy capital due to its conservative investment portfolio, defensively positioned balance sheet, and strong capital and cash flows. As you can see in the next slide, the return on capital invested has been lower than the overall cost of capital, generating a negative but improving economic value added for investors with respect to capital utilization. This further enforces our hold recommendation. On the next slide, capital deployment and value creation are enabled by Aflac's superior financial strength tied to its strong insurance ratios. As you can see on the top, although Aflac's loss ratio has declined and stayed below peers average, Aflac's expense ratio has increased and even advanced over the peers average since 2015. We believe these trends to continue in the future, which further endorses our hold recommendation. Additionally, on the bottom, Aflac's persistency percentage and benefits ratio has remained strong and steady, with expected trends to stay the same or even improve slightly. Next, we will discuss near-term headwinds due to COVID-related disruptions. Since 2019, Aflac has experienced a tremendous decrease in sales related to COVID-related disruptions, stemming from working from home, social distancing, closing of businesses, and difficulties from selling virtually. Decreased sales will continue to suppress premiums and earnings growth in the future. However, Aflac has maintained stable margins through the period of COVID. It's worth noting in 2020 Q3, Aflac experienced a considerable increase in their net income margin. That's due to a $1.4 billion tax benefit. We expect short-term sales to be depressed. However, long-term, we expect Aflac to improve sales in both the US and Japan market segment. Next, I will send it to risk.
To assess the risks Aflac faces, we utilize the PESTEL analysis, which categorizes those risks as political, economic, social, technological, environmental, or legal. Our team assessment of those risks is summarized on the next slide, utilizing this risk matrix, which plots each major risk on its respective probability and potential impact on the firm. US interest rates are at an all-time low as a result of the COVID-19 pandemic, and the Fed has expressed no intention of increasing those rates until at least 2023. Japanese government bonds are also remaining low. These depressed interest rates have potential negative impacts on Aflac's investment income, especially with half of Aflac Japan's global portfolio being comprised of JGBs alone. With Aflac's prominence in the US and Japan, it has great exposure to fluctuations in the exchange rate between the US dollar and the yen. While the company houses an effective hedging program, large fluctuations in this exchange rate could poorly impact the company's reported financial position and its operating results through hedging losses and declining asset value. Additionally, with the transfer of power to President Biden, healthcare reforms are already beginning to take place in the US. Significant changes in the legislation surrounding insurance in the US or Japan could negatively affect Aflac's profitability and the extent of its business operations. Cancer rates in the US are rising due to aging populations and poor lifestyle habits such as eating unhealthy foods and sun tanning. Additionally, Japan has the largest age 65 and up population as a proportion of total population of any country. As people grow older, the likelihood of developing cancer increases substantially. This trend of increasing cancer rates must be effectively planned for, or else actual medical payouts will exceed Aflac's anticipated payouts, decreasing its profitability. We will now be discussing Aflac's ESG score.
The environmental, social, and governance scores evaluate a company's enterprise value regarding its social and sustainability risk on a scale of 1 to 100, with lower scores being more favorable. As you can see from the graph on the left, Aflac has performed better than its peers historically, and in 2019, the overall score became more favorable. This can be attributed to Aflac publishing its first ever ESG Hub, which is a website dedicated to showcasing the Aflac Way, which is the company's commitment to promoting ESG and CSR efforts by balancing both purpose and profit. On the next slide, you will see that Aflac has coined the phrase smart green to refer to the company's daily effort to wisely choose, use, and dispose of all resources. To support smart green, the company is looking to become completely paperless in the near future, as well as reducing carbon emissions by 75% in 2030. When looking at Aflac's social initiatives, it is important to note the company's dedication to its employees and local communities. As Aflac CEO Dan Amos said, if you take care of your people, they will take care of your business. And in 2019, the company spent about $10 million into 20 different skill set trainings and is looking to increase the amount of women in leadership roles. The company also continuously strives towards leaving our duckprints through philanthropic monetary contributions. The next slide showcases Aflac's Institutional Shareholder Services Group of Companies, or ISS scores, which evaluates the company's governance risk. As you can see, audit and compensation carry very minimal risk. However, board structure contributes the most to the company's governance risk, which can be attributed to the position of CEO and chairman of the board being conflated, as well as the fact there are no term limits for board members. I will now pass it back for concluding comments.
1 minute remaining.
Our hold recommendation strikes a balance between headwinds such as revenue weakness and a negative but improving EVA spread, and tailwinds such as long-term growth prospects in the US and an attractive dividend yield and share buyback program. Thank you very much for your time. We're very grateful to be here. We will now take your questions.
All right, thank you very much, team. Great presentation.
Bit more about your peer group and how you derive that in terms of your valuation model.
Absolutely. So our peer group consisted of MetLife, Manulife, and Prudential. And our justification for choosing those peers was because after Aflac, those three had the greatest exposure to Japan. We had considered peers such as Unum and Lincoln, which operate in the US only, and Orix, which operates in Japan only. However, these potential peers were too small by metrics such as revenue and market cap. And additionally, they had insufficient international exposure to be considered adequate peers.
Do you feel that having a sample size of 3 might be a little too narrow?
We feel that because this is common to the industry and other reports that we have seen, that this was an appropriate sample size to use. In addition, because of the similar multiples.
Thank you.
Also, I believe within your valuation discussion, you mentioned Aflac has historically outperformed the market as well as the sector, but that coming since COVID, it has underperformed the market, I believe is what you said, and was wondering if you took into account what the sector has done since COVID.
Well, clearly since COVID, the sector has fallen to a lower low and has recovered even more slowly than Aflac and subsequently slower than the market.
So is it fair to penalize Aflac for underperforming the market when the whole sector has done that?
I think that because investors would seek to diversify their portfolio with more than just insurance companies, it's important to note that this particular insurance company is underperforming the market, but it is outperforming other insurance companies. So this is supporting our hold recommendation because we're saying investors, Aflac is outperforming insurance sector. However, there are other companies in the market that might be better suited to your portfolio.
Which initiatives are the company taking, do you think are going to move the needle the most? This is a pretty big company, so you got to do a lot of things to move the needle.
Absolutely. So navigating to the acquisitions, Aflac has done the strategic acquisitions for dental and vision and group benefits and pet insurance. And these, I believe, are estimated to increase annual revenues. Management estimates a $1.8 billion increase in annual revenues over the next 3 to 5 years. So compared to the $20 billion current annual revenues of Aflac, this should move the needle about 5%, 5 to 7%. And we expect Aflac to continue on its trend of inorganic, opportunistic strategic growth with businesses that relate to its core models.
And I'd like to add real quick, Mr. Curtis, thank you for asking that question. When you're talking about the incentives, the initiatives that Aflac is currently taking, I believe it's not overstated to look at the digitalist virtual selling. That's going to be a game changer, I believe. Our team believes for the industry of the insurance industry in tapping on markets that have not been touched yet by Aflac, and also people have access to their products and also easier access to those online.
Are these folks leaders in that, or are they followers?
Sorry, could you repeat that, sir?
Is Aflac leaders in that, or are they followers? What's your assessment?
Aflac tends to be a leader. However, note that MetLife acquired Bequest, which is a digital estate planning company, in 2019. So MetLife is leading Aflac marginally in this aspect. However, this is only one of several of Aflac's core business products. Otherwise, Aflac has historically been an innovator and in fact pioneered cancer insurance in Japan as well as supplemental insurance in the US. However, because of the rapidly increasing digitization, Aflac will have to move swiftly to keep ahead of competition in the near term.
It is also worth noting that while Aflac has been experiencing inorganic growth with all these acquisitions, its acquisition of Singapore Life is exploring the expansion into the Southeast Asia sector, while it has historically been limited to Japan and the United States. And if that partnership comes to fruition and they do expand into those South Asia countries, that has a lot of room for Aflac to expand organically within those countries.
Following up on Curtis's question, what's their record as far as success with these bolt-on acquisitions? Do they take them and, do they add value once they've acquired them? Do they kind of stay in place, or do they just get subsumed into the larger company and you can't really tell?
It is difficult to measure, particularly because some of them have happened just so recently. However, some of them have produced positive revenues as of yet. It looks like Trupanion, the strategic alliance, it's too soon to tell. And same for Dental and Vision, that just launched this quarter. However, with the group benefits and the increased brokerage expansion initiatives by Aflac have shown positive revenues. And so we're upbeat on those prospects for the other acquisitions as well.
To add in that as well, my teammate mentioned it earlier in the presentation, Aflac is built to grow. So they're not looking specifically for large mergers and acquisitions. Instead, they're looking for firms that can help them build within their penetrated markets in Japan and also the United States.
Yeah, it's yeah, I was just curious as to, there tends to be tension when you take an old line company that bolts on a digital company, and whether they're successful in doing that is kind of what I was curious, what your opinion about how successful they have been in doing that.
Absolutely. And that just because of the onset of the pandemic and all the uncertainties and delays that's caused, we're just going to have to wait and see in the near term, because as of yet, it is a little bit muddy. You're absolutely right about that, which is part of the reason for our hold recommendation.
Thank you. That's helpful. How do you see younger generations in the Japan and the US? How do they view Aflac's key products?
Let me navigate to 35. Aflac is viewed in a positive light by most of the workforce, according to Aflac's 2020 workforce report. Its name recognition is 91%, which is higher than the world's literacy rate. I don't know whether to be happy for Aflac or sad for the world, but the younger workforce is shrinking in Japan because of the aging population, and digitization occurs a little bit more slowly over there just because of industry trends. That's the norm over there, and because of the aging population. Now, in the US, like I've mentioned, this slew of initiatives was really just launched, kind of announced in July. And so it's been under development. Aflac's been pouring capital into it. And so it's difficult to tell as of yet. However, because of trends in other industries, kind of peer-to-peer, app-to-consumer, Airbnb, Uber, we anticipate that it will be widely expected and appeal to a younger marketplace. Aflac, its key digital initiative is the Aflac One digital ecosystem, which aims to connect brokers, agents, consumers, and the firm all together. It's developing this and planning to launch it in 2021.
And to also add to what my teammate had to mention, the younger generation is looking forward to the technology shift that Aflac has now started, believing that it's going to tap into new markets, but also the life cycle products that Aflac does experience and sell in Japan. They're trying to target that to the young generation, but also look at the older population as well.
Additionally, with cancer rates increasing, while most of them are due to aging populations, we're also seeing a large increase in adolescent and young adult cancer rates increasing due to many factors such as obesity-related cancers, and with Aflac's venture into more and more cancer-related policies, if those young adult and adolescent cancer rates are continuing to rise, they'll be seeking those cancer insurance as those younger age groups become more accustomed to the risk of developing cancers.
Okay, thank you. What about, have they talked about succession planning at all, given that the current CEO is a family member and is, I guess, in his late 60s?
To our knowledge, the firm has not mentioned or acknowledged any sort of succession plan. Please feel free to correct me if I'm wrong, teammates.
Yes, we have.
Okay, thank you.
So I've got a question on your valuation methodologies. You mentioned at the start you're upbeat on growth, and you've talked a bit sort of qualitatively about these opportunities, say in pet insurance and different geographic markets. You also mentioned that you did not use the DCF model because due to unreliability of cash flows in the insurance industry. So what I'm wondering is, did you do any modeling on growth opportunities? And if you did, what sort of growth number are you arriving at? And where do you have that incorporated into one of the valuation methodologies that you did choose to go with?
That's a great question, Nicole. And so just to clarify, you're saying that you're basically asking us if we incorporated Aflac's long-term growth potential into essentially the perpetuity growth rate. Gotcha.
Yeah, so I can take that over from my partner. So we implemented a terminal growth rate of around 8.2%. I want to say, if you go to the next slide, should be down there at the bottom. So we implemented this based off of a forecasted BV book value per share growth rate due to Aflac's growing profitability and stock repurchase program.
And to just follow up on the other part of your question, Nicole, because what we had talked about with Steve about how it's a little bit muddied right now with the COVID pandemic, and we haven't seen too many hard, tangible returns yet, we thought it would be difficult to justify any specific empirical increase to the growth rate based on bolt-on acquisitions and long-term growth. However, we do have a bull case and a bear case here that slightly answers your question.
Thank you. Nicole, do you have a follow-up for the valuation?
I can let others step in with a question since
We're out of time, so I just wanted to make sure that you got what you were looking for.
Yeah, I think just maybe a brief follow-up would be, you mentioned the share buybacks versus growing profitability. Did you do a breakdown between those two to arrive at the 8.2%?
No, ma'am. Unfortunately, we did not. We just based it off of, we did a CAGR on their forecasted book value per share, which we got from Bloomberg.
Thank you very much.
All right. Thank you, Team C.
Thank you, guys.
Thank you guys.
Thank you all.
All right, Team O, congratulations on reaching the finals. We are excited to hear your presentation. We know it'll be great. We are going to give you 10 minutes to present. I'll start the timer once you start speaking, and I will verbally cue in when you have 1 minute remaining, and then we will give the judges panel 10 minutes to Q&A you after your presentation. So is your whole team ready to go?
We're good, thank you.
All right, have a great
Sorry about that. Hi guys, my name's Ellery. I'm joined with Will, Brett, and Jacob. We are Team O, and we are pitching Aflac at a buy with a price target of $56.90 and an upside of 20.35. Now, before we get into the details of our pitch, I just want to give you a quick overview of the company. So Aflac was started in 1955 in Columbus, Georgia, and they have since grown to become the largest provider of supplemental insurance in Japan and the US. Their products are sold through 4 main distribution channels, and they are pushing group coverage and individual coverage. Together, these provide Aflac's customers with a wide range of supplemental and voluntary insurance plans. This has produced the stable revenues for the company throughout their history, and currently, Japan serves 69% of these revenues, with the US bringing in 31%.
Kobe, I believe you're muted. Just unmute your mic.
Sorry about that. So an overview of the industry, and take a look at our SWOT analysis. Within Aflac has strengths, but then it has strong, consistent free cash flows from its Japan segment that it uses to fund its growth in the United States. It has weaknesses in that it has had trouble expanding historically in the United States without acquisitions. Outside Aflac has opportunities with the trends to direct-to-consumer sales within the industry, but it has threats of distribution problems that it has had in the past relating to Japan Post. Looking at our Porter 5 Force analysis, the biggest threat here is probably the competitive rivalry that has been pushing down premium prices recently. Premium prices had a rough year in 2020 with negative growth, but are set to recover in 2021. As you can see, Aflac has fared pretty well throughout this process. In the past 2 decades, there has been lowering interest rates, but Aflac has been able to keep their net margin high. Aflac now has the highest return on equity out of their peer set.
Now moving into our thesis. We really believe the story for Aflac is that their more stable and mature Japan segment throws off significant free cash flow, which allows them to drive growth over on the US side. We're going to start with Japan. Aflac has a leading third sector market share in Japan with about 60% of the cancer market and about 15% of the medical industry. Their distribution network is vast and is a great asset to them, but it's a little different than how they do things in the US. While about 80% of the sales originate from the agency network similarly to the US, they also have a partnership with the Japan Post that allows them to distribute through more than 20,000 postal outlets, as well as an agreement with 90% of the banks in Japan that allows them to distribute from there as well. They're also building out a digital platform that's going to allow direct-to-consumer distribution. While Japan's a pretty concentrated and mature market, we do believe that there is some room for growth, particularly in the cancer market. As you can see, penetration in the cancer market is significantly lower than that of the life and medical sectors, and it's been growing at a significantly higher rate. This aligns perfectly with Aflac's recent focus to shift more to the third sector. The third sector consists of the medical and cancer policies, And since 2016, when Japan turned interest rates negative, Japan's been shifting more and more of their revenue towards this third sector, as the third sector policies are less interest rate sensitive than their first sector counterparts and therefore yield higher margins.
So as Will was describing, the main story for Aflac today is that they're going to use the cash flows from their more mature and stable Japan segment to actually fuel an aggressive growth expansion strategy in the United States. And so Aflac's market in the United States is significantly underpenetrated comparing to the Japanese market. And to just quantify that a little bit, employers currently offer Aflac to around 50 million Americans. However, only 8 million of those Americans actually have supplemental life insurance policies under Aflac as of 2019. And so management recently launched their new buy to build strategy in 2019, which is basically where they're going to acquire well-built and industry leaders in the group benefits and front page benefits life insurance market. And these are basically benefits that are more important to employees than Aflac's traditional supplemental life insurance policies. These are your traditional life insurance group benefits, as well as dental and health vision benefits. And so recently in 2019, Aflac actually acquired Argus Dental and Vision and Zurich Group Benefits. And these acquisitions are expected to be fully integrated into the Aflac system in Q1 of 2021. And this is really critical to Aflac because instead of spending years and millions of dollars recruiting new talent to lead these new divisions, they can actually just acquire the best in the business right now and using their reach and their distribution networks, merge them with Aflac in order to start targeting these front page benefits. And so we really see the main story for Aflac today is that they're going to be targeting these front page benefits to give more customers access to Aflac's brand. And once they're actually purchasing these front page benefits, such as main life insurance policies and dental and health vision policies from Aflac, they'll slowly be able to transition it to their more higher margin products, such as their supplemental life insurance products. And we're projecting that this is going to have a significant fuel to a top line revenue growth as per management guidance over the next 5 years. And briefly just touching upon their Trupanion deal, they purchased a 10% stake in them in October 2020. And this is basically saying Aflac is going to be the exclusive provider of Trupanion, which is basically pet insurance and all of their work sites in the United States over the next 2 to 3 years.
Now for a bit of financial analysis, the question we really asked ourselves here is how does an insurance company make money? And that's through their underwriting profit along with their book yield. So starting with the combined ratio, which is claims and expenses divided by net premiums, Aflac has had an excellent combined ratio due to their very disciplined and prudent underwriting, and they've actually worked that down over the last 10 years, generating more and more underwriting profit that makes up the core of their business. Along with that, their diversified investment portfolio has yielded consistently above the risk-free rate, and these two things have combined to generate stable revenues and then stable net income over their history. As you can see, adjusted net income has grown at about a 6.5% CAGR over the last 5 years. But what we're really looking for there is the consistency. That consistency allows them to continue returning value to shareholders. In recent years, Aflac has used more of that profit to buy other companies and acquire them in order to catalyze growth, specifically in the US. But management is guiding over the next couple of years, they're going to use more and more of those profits to return cash to shareholders. They do this largely through two methods, dividends and share repurchases. With 38 straight years of dividend boosts, as well as a 18% hike for the first quarter of 2021, they remain extremely committed to this and are estimated to deploy $8 to $9 billion in capital from 2020 to 2022.
First and foremost, in an ESG analysis, it's important to identify the key areas of impact that a company can make within a community using their core business model. So these mean impact opportunities. In Aflac's case, these impact opportunities were access to affordable healthcare, decent and equal work opportunities, and being an honest and accountable institution. After identifying where I felt Aflac could make the biggest impact on their stakeholders' lives, I then looked through a series of ESG tools, screeners, and databases in order to identify the most relevant data points to each of these impact opportunities. I also went through Aflac's ESG company-provided materials and identified whether or not they were using the commonly used ESG language in order to identify how current they were in the industry. Now, moving on to the next slide, this holistic idea of how ESG and Aflac are related is really important because in the last 30 years, we have seen a 339% growth in ESG incorporation of funds, which means that there's a whole lot more money going into positive companies. This bodes incredibly well for Aflac because when they're placed in their peer group and their overall normalized Z-scores are compared to each other, Aflac is number one, meaning that if an ESG fund is looking for an insurance company, Aflac will be the one that they pick. Not only that, but Aflac will not be ruled out in any due diligence processes that have to do with ESG because they do pass all screens that are available.
And so while we paint a pretty bright future for the future of Aflac, we do briefly want to touch upon a few investment risks, the main one being their Japan Post scandal, which we'd be happy to provide more clarity on in Q&A. But however, their policies were not involved in the mispricings. It was basically just the Japan Post management, and Aflac is expecting this revenue branch to grow back to full potential within 3 to 5 years.
All right, so a brief overview of our valuation. In our relative valuation model, I use an average price to book value multiple over 3 tiers of public comparable companies to get to an implied price to book value multiple of 1.22 and implied value per share of $59.21.
1 minute.
Now moving over to some of our intrinsic methods, we utilize the dividend discount model that yielded a value per share of 53.58 and a residual income model of 49.46. And I'll get a little into the assumptions in those models on the next slide. We're having a problem with our slide deck here, but our first assumption is that net income is going to tick down in 2021 and 22 due to higher expenses related to expansion in the US and their digital build out. We're projecting a return to growth in 2023 as that expense ratio ticks down. Brett, can you go 1 slide forward? Awesome, thank you. And then our cost of equity is determined using CAPM, and we reached a value of 8.65%. Additionally, we used a terminal growth rate of about 2.5% in line with GDP growth. Our blended valuation, Brett, just go back 1 slide. Our blended valuation used equal weightings of 15% on the dividend discount model, residual income model, and 70% on relative. We used a higher weighting for our relative due to our confidence in Aflac's given comps, as well as the inherent risks of the assumptions in intrinsic valuation. In conclusion, Aflac is a leading supplemental insurance provider, and their more mature Japan segment is going to continue to throw off that cash flow, which will be able to be used for growth in the US. And with that thesis, we are recommending a buy with a price target of $56.90. Thank you for your time, and we'd like to open up the floor for questions.
Thank you so much, team. Great presentation. We look forward to hearing from the judges. Judge Natalia, would you like to lead off the Q&A, please?
Sure. Thank you. So the first question I have is if you could go back to the valuation and you selected the relative valuation at the 70% weighting. Yes, thank you. So why did you select it at 70%? I know you said because you have confidence, but can you give a little more detail as to what the confidence is based on?
Yes, well, our tier 1 group of the relative valuation is comparable companies provided by Aflac. So we felt that those provided really the best way for us to value the company. Additionally, and looking at street valuations, we saw that a lot of weight is placed on relative typically. Additionally, in a complicated company like an insurance provider, we felt more confident in relative valuation as opposed to the heavy assumptions involved in projecting out intrinsic valuation. So that's why we stuck with the higher weighting there.
Well, it kind of looks like this was the valuation that gave you the highest share price projection. So you're not concerned that this is going to be a little bit too high if you use this type of method?
That definitely is a concern. And we thought about that and we realized the optics of that as well. But as I mentioned previously, with such a complicated model, we felt it was better to weight relative more, but we did want to give intrinsic at least a 30% weight because, as you said, those valuations were a little lower and we felt they would average out appropriately.
Okay, thank you.
May I ask, what was the multiple that you arrived at in the relative valuation to get to that 50?
Yeah, the multiple is 1.22 price to book value.
All right, use price to book. That's
correct.
Also on that valuation slide, you indicated an estimated 2.5% GDP growth with what, around 70% exposure in Japan. How did you arrive at that?
We decided to go with 2.5%. We did acknowledge that obviously with 70% in Japan, we're working with two different GDPs, obviously, and GDP in Japan has been growing a little slower. But because we project more and more of their business to come from the US and they are based in the US, we decided to use a 2.5% growth rate, really as not to have that is what's driving the majority of our model, but more to just keep it in line with growth of, I guess, the country as a whole.
Can you tell me a little bit more about the peers that you selected in your comparison for a relative valuation?
Yeah, sure. So I did 3 different tiers actually. In the tier 1 would be company provided peers from their proxy statement. So we kind of felt those were most closely related to Aflac, and we put a 90% weighting actually on these peers, and that tier actually had the lowest average price to book value. And then in their tier 2, we selected other life and health insurers that were not in tier 1 that were above $2 billion market cap. We felt this kind of encapsulated more of what Aflac is. And then in tier 3, we chose other property and casualty insurers that were also not in tier 1, that were also above a $2 billion market cap. So just to recap, tier 1 had a 90% weighting on it, and tier 2 had a 5% weighting, tier 3 had a 5% weighting as well, and that got our relative valuation.
Any particular peers that attracted your attention as being particularly comparable?
Yeah, I mean, so some of the ones they projected in theirs, I guess some of the more comparable ones would be, probably the most comparable would be MetLife from the one I saw, but there was a lot of good peers in the tier 1 set.
Okay, good. Glad I got bifocals so I can look at this.
My apologies, it's so small, I know.
No, thank you. This is good. This is good. Thank you.
One more question. Go ahead.
I was just going to ask, what level of concern do you have about the interest rate environment and their investment portfolio?
With interest rates remaining low, we actually think the market may be placing too much weight on this. As you know, when interest rates are low, you assume insurance companies are going to make less money, which is obviously true. But I think going back to the graph on our financial analysis slide, what we use kind of as a baseline is more against the 10-year. Obviously, rates are going to go down, and that's going to affect the industry as a whole. But we feel that their portfolio, actually recently they've added more exposure to growth, but we feel that their portfolio has the ability to yield above whatever the interest rates are, and their really strong underwriting allows them to not rely solely on that book yield.
So one more question. What risk factors do you see affecting Aflac the most in the future?
Yeah, so the main risk actually we think is coming from the Japan Post scandal. Basically, there was a whole problem with the distribution from the Japan Post, and there were a few policy mispricings, but that was actually by Japan Post management, and Aflac had no real involvement in that. And so they recently underwent a massive, basically a PR campaign with some of their Japan Post customers. They were basically calling a lot of their customers saying like, hey, this wasn't our fault. Our policies are not affected by the Japan Post scandal. And that's had a slight effect on their top line growth, but management is predicting that that is supposed to go back to normal within the next 3 to 5 years. And of course, with interest rates remaining depressed, that is another one of our main investment risks, but primarily they have indicated that they're going to recover from the Japan Post scandal relatively well.
And I'll add just a little bit to that. ESG is often used in risk analysis. And from what I found with Aflac, they're positioned pretty well in ESG, and they're a well-practicing company. So I don't really see any risks coming from ESG either.
What about foreign exchange? Do you see any risk there?
The biggest risk, to my understanding with foreign exchange, is that it's really going to increase their hedging costs. So Aflac's reduced their their exposure to these foreign exchange rates through hedging costs. So while I don't feel comfortable forecasting foreign exchange rates, in the event that foreign exchange rates are unfavorable, I think the largest effect would just be greater hedging costs, which obviously isn't positive for the company, but we don't feel that will have a material impact on their financial statements.
Okay, thank you.
If we stay on this slide, so you kind of, in terms of their growth strategy, you kind of refer to the Japanese market as somewhat of a stable cash cow that would be used to finance other expansions. So if you go back to that slide, you kind of refer to Japan's declining population as an insignificant risk. I mean, do you see them being able, how long do you see them being able to continue just leaning upon Japan when their population is declining, their economy is declining? I mean, what do you see that, how do you incorporate that?
Yeah, that's a great question. That's definitely, like, as we've shown there, definitely something we thought about. Again, we do see them shifting more of their business to the US and kind of reducing some of that exposure, but Japan's declining population isn't exactly a new phenomenon, and they've been able to produce fine returns from Japan, as you guys have been able to see over the last 20 years. But we also believe that with the declining population, there's more and more awareness of cancer and other illnesses going on in Japan. So not only does the declining population reduce the people available for policies, which is a downside, it's at least partially mitigated by the fact that people are more and more aware of, for I guess lack of a better word, that death is part of life, and they need to be ready for that.
We have time for one more question, judges.
Can I ask one about their, if I understand their growth strategy in the US, it sounds like they're going to compete more in traditional areas that other companies are already established in, and then try to sell their core products within that group. So it's kind of like a two-step, a couple things have to go right. So what are the odds of them being able to execute that?
Yeah, that's definitely something we thought about a lot, especially as they're moving more into their front page insurance benefits. That's more of a penetrated market. But we believe that due to their brand strategy, they're definitely going to be able to compete well with more traditional life insurance companies, and along with them specifically emphasizing acquiring well built out companies such as Argus Dental and Vision, as well as Zurich North America's group benefits. They don't really have to spend a lot of money and a lot of time building up their infrastructure, recruiting people. They can just go in and start using their cash from Japan in order to start building up their segments. And management is really emphasized upon their brand recognition in the United States, that once they start marketing these companies slightly different, they'll be able to get essentially get more customers that are just familiar with the Aflac brand compared to the Argus or the Zurich brand.
Just to add on to that really quickly, as Brett had said in his slide, it's really that buy to build strategy where they're instead of trying to grow organically in a space that's very competitive and difficult to grow, they're finding the people they think have built out the best platform with an already established customer network, and instead of trying to grow organically, growing through acquisition.
Thank you
very much, students. It was a great presentation. You are free to remain in the breakout in this main room. Just please turn off your cameras, and you can watch the remaining teams compete. And if the judges will please go to their breakout room, we will spend the next 10 minutes compiling scores. Thank you.
Thank you guys for your time.
All right, Team B, congratulations on reaching the final. We are excited to hear your presentation. We're going to give you 10 minutes. Once you begin, I'll start timing, and I will give you a 1-minute verbal warning. And then we will pivot to a 10-minute Q&A from the judges panel upon completion. So if you have your whole team here and you're ready to start, begin at your leisure, and good luck.
Okay, just give us 1 minute for me to get my screen shared.
You take your time. We'll start once you begin.
Okay, perfect.
Of course.
All right, thank you all for joining us today. We're obviously Team B. My name is David Stalin, and joining me is Gabriella Waters and Allison Dooling. So just a quick review of what we're going to be going over today. So first of all, we're issuing a buy recommendation with a price target of $57.73 based on those models below. Current price is trading at $48.08. And we're giving this recommendation for 3 reasons. Their superior competitive advantage, their steady earnings and dividend growth historically and in the future, and then their handling of the COVID-19 pandemic. And now I'm going to kick it over to Gabriella, and she's going to talk about the company.
Thank you, David. So starting off with the business description, Aflac was founded in 1955 as the American Family Life Insurance Company of Columbus. They are headquartered in Columbus, Georgia, with 2 major segments within Japan and United States. Aflac is the leading provider of supplemental coverage and insures more than 50 million people with supplemental life and cancer insurance. Aflac has an annual revenue of $20 billion. Corporate governance. Aflac has a diverse executive team and board of directors. The board of directors regularly evaluates the company through the Corporate Governance Committee. Environmental and social impacts. Aflac has an ESG score from MSCI of BBB. From Sustainalytics, it has a 23.3 score, about a medium risk, and from Insight, a 65 out of 100. Social impacts include Aflac's Smart Green program, which is a program that accomplishes environmental responsibility goals by educating and encouraging social and global responsibility among employees. Environmental and social goals are Aflac has made sustainable investments of $1.7 billion. They have pledged to be carbon neutral on or before 2040, and Aflac has donated over $148 million towards the fight against childhood cancer in the United States and Japan. So a little bit about industry overview. A SWOT analysis was done on Aflac. Strengths. Aflac's main strengths is market presence in Japan and wide variety of product offering. The main weaknesses is the small online presence. Opportunities include expansion into new markets, innovation of new products developed from COVID-19, and the shift from office environment to work from home. Threats include economic downturn from COVID-19, foreign exchange risk, and strong competition with Allstate and MetLife. A correlation matrix was performed with 3-year period from December 2017 to December 2020, with Aflac's beta of 0.96, R squared of 0.46, and a standard deviation of 26.5%. Aflac is not an extremely volatile stock. Aflac has a small correlation with the market and a relative correlation with the sector. Macroeconomic outlook. Overall, the insurance industry took a hit from COVID-19. Japanese growth is relevant with it being the 3rd largest economy in the world with an annual GDP of $5 trillion and 70% of all of Aflac's premium revenue coming from there, along with insurance premium revenue growth of around 5% over the last several years. Artificial intelligence is expected to grow significantly, and demographics are shifting with the retirement of baby boomers and the creating of new offerings to the millennial generation. And now I'll hand it off to Allison, who will be talking about financial analysis.
Thanks, Gabriella. So some opportunities and risks that are important to consider when looking at Aflac. First of all, we have to examine the future growth opportunities. Aflac has demonstrated steady revenue growth in the past couple of years, which is important to see for a company of its large size. We also need to consider the opportunities. They have opportunities for international growth as well as new product development. In fact, Aflac is working to partner with Trupanion to provide its customers pet insurance, and investors should expect to see a return on this investment in R&D. In terms of their liability, it's important to consider that this industry faces a high risk of liability due to the risk of claims. Aflac does offset this by investing in fixed income portfolios that provide a steady rate of return and help hedge against those risks. Here are the financial ratios we'll be looking at in the next couple slides. In terms of profitability, Aflac has lower revenue than its peers of roughly $21 billion compared to Allstate's nearly $40 billion revenue. However, Aflac's profit margin is about 13%, which demonstrates a higher profitability of those sales. Their EBT margin demonstrates a strong management of costs and expenses. However, investors do need to be aware that there is a low return on assets as well as a low return on equity that needs to be considered before investing. In terms of efficiency, this is the most important factor to look at when looking at insurance companies. We need to see tight asset management from insurance companies, which we do see in Aflac's total asset turnover and fixed asset turnover ratios. It's also further impressive to see these good ratios considering that most of their assets are tied up in investments. In terms of financial leverage, they do have a debt to equity ratio of 0.25, which is low, and a high interest coverage rate of 18, which presents low risk and the high risk of claim. In terms of liquidity, they do have adequate coverage of their current liabilities by their current assets, which again is important to see in that tight asset management. This coverage is again important due to the high liability they're facing. We also looked at some industry-specific ratios for the insurance company. In terms of their solvency margin, they have over 100% solvency, which is really high and really great compared to competitors. However, they do face a high claims ratio, which does offset these benefits of high solvency. However, when we look at their claims ratio of roughly around 65%, their competitor also actually has a higher percentage of claims, roughly around 70%. So overall, the company outperforms these industry averages and is fairly comparable. And so we're going to pass it along to David, who's going to look at a valuation of Aflac.
Thank you, Allison. So when we first did our valuation, we started out by doing an income statement forecast for Aflac. So we used our historical revenue figures of 2.5% over the last 10 years and bumped that up a little bit based on some of the growth opportunities Allison talked about. Then we used historical figures for the direct costs with 0.5% decreases annually. And that gave us a 2020 operating margin of 19%. And an EPS of $4.44 for Aflac this year and a 14% operating margin. So then we moved on to our discounted cash flow models and used a beta of 0.96, a risk-free rate of 1%, and a market rate of 8% to get a cost of equity of 7.7%, and also a weighted average cost of capital of 6.8%. And you can also see some of our free cash flow and dividend growth figures over the last 10 years. We then developed our discounted cash flow models using the 2021 $1.32 dividend that Aflac already announced earlier last year. Then use a terminal growth rate of 4% and our cost of equity of 7.7 to get to a price target of $40.77. We also use a terminal growth rate of 1% for free cash flow to come to a price target of $1.04 and $104.84. We then developed our multiple model using that earnings per share identified earlier, $4.44, and their 5-year historical PDE ratio of 10.04. Giving us a price target of $44.53 for this year. We then compare that to Allstate, one of their closest competitors in market cap, who has a PE ratio of 11.68, and that gave us a projected price of $51.83 using that PE. So using these three models of $44.53, $104.84, and $40.77 with 25, 25, and 50% weights, we came to a base case price estimate of $57.73. We then developed our upside model using 4% revenue growth for this year, giving us EPS of $4.71, 5% terminal growth rate of the dividend model, and a 1.5% growth rate in free cash flow to give us an upside model of $70.50 for the price target of Aflac. We also developed a downside model using 2% revenue growth this year, giving us an EPS of $3.85, a lower payout ratio to give us 3% terminal growth, and stagnant free cash flow after the small decreases we're going to see over the next 5 years. This gave us a downside estimate of $47.22 for Aflac. We then identified some investment risks associated with investing in Aflac. Number one is the fact that 85% of all assets are tied up in investment securities, specifically in U.S. corporate bonds and yen-denominated government and agency bonds.
1 minute remaining.
So this means they're relying heavily on global economic growth, especially in the US and Japan, and also are susceptible to some foreign currency translation adjustments. They also have the COVID-19 risk of increased liability claims that all insurance companies are facing, as well as some liquidity concerns that they had early on that they were able to fix with raising some early debt. So in summary, we again issue a buy recommendation with a target of $57.73. This is about 20% higher than their current price on Friday of $48.08. And we're also projecting that 2.5% dividend yield for this as well. Are there any questions?
Team, thank you very much. Great presentation. And we will now turn it over to the judges panel for a 10-minute Q&A. Thank you.
You were, go ahead, Kurt.
I'll pass. I'll pass the baton to you first.
You mentioned Allstate as a peer. Were they the only peer that you used, or were there any other peers that you used in your valuation?
We also looked at MetLife as well in our original paper, but Allstate is closest in market cap, and that's why we chose them as the closest competitor to use. Since Aflac kind of specializes in their own thing mostly, it was kind of hard to find someone who was the closest competitor.
Could you tell me a little bit more about the ESG analysis? I wasn't sure what your conclusion was. You told us what you looked at. So could you give me a little more depth on that?
Of course. So over the last few years, Aflac has been ranging around from a B score to a BB. That's according to MSCI, which is below average, but they have been working to improve it. And so now they're currently at a BBB, which is an average of the industry overall.
Also,
Right, thanks.
if I could add to that, the reason that their ESG score rating is closer to a BBB as opposed to being higher is there's two main things that are kind of dragging them down in the industry. They're low in financing and low in responsible investing. However, when we looked at some of their investments, they're doing it to offset those liabilities. So that is probably contributing to their lower rating, where in everything else, they're pretty much right on target. They're not necessarily outperforming, but they're on target for where they should be.
Okay, thank you.
And what are you said they're working on improving the ESG aspects of their business. So what exactly are they doing?
So I know that they are working to improve their global community social goals. Basically, that's why they have been making sustainability announcements of the carbon neutral emissions, and then they've also been improving with their social responsibility through the donation of childhood cancer.
Okay, thank you.
Could I see your?
Sorry. Go ahead, Nicole.
Okay, thank you. You mentioned they have, you talked about the growth opportunities, including steady revenue growth that the company already has, as well as the international markets, new products, and then sort of their competitive advantage. And I noticed that you also modeled out looking into the future cash flow. So what I'm wondering is what sort of growth numbers did you put on those revenues, and did you do any analysis to figure out how much revenue growth are they going to have from going into new international markets versus new product offerings, and how much growth are they going to achieve by taking competition away from their taking revenues from their competitors?
Yeah, so specifically, the main thing was the growth that we're expecting in Japan. So over the next 10 years, insurance growth in Asia is supposed to be around 8%. So that extends to Japan as well. And they've seen about 5 to 6% growth in Japan annually. So that's where we were getting a majority of our revenue growth figures. Also, they do have some expected growth in the US as boomers start to get older and they're starting to appeal more to the millennial generation. They're expecting a little bit more growth as they market some things towards them. But mainly Japan is where it's growing. And again, that's 70% of their revenue. So obviously that's where you want a majority of your growth coming from.
And thank you for that. Is that consistent with the capital allocation strategy that the company's talking about in terms of what they're doing with, say, dividends and then share buybacks?
Yes, it is.
Thank you.
Could I see your dividend and free cash flow model slide or slides again? in your free cash flow analysis, are stock buybacks accounted for? How do you address that issue?
They haven't been doing a lot of share buybacks recently. They're really focusing obviously heavily on dividend growth, as they announced, I believe it was in October, that they were going to upgrade it to $1.32 this year. So that's really where they're expecting to grow things. As far as share buybacks, just a little bit here and there is the plan, is kind of what they announced.
So I'm buying the stock because I can get it at a 2018 price now, what it used to trade for in 2018. What's my reason for buying the stock?
Because we're expecting dividends to grow quite a bit. In fact, actually, they've seen 40% growth since October. So they've actually grown quite a bit since then. But so you're also going to get a steady dividend. At some point, we're expecting that to reach around 4 to 5% yield, which is pretty good for a stock like this. And they're also going to grow over the next 5 to 10 years. So that's really what we're buying it for, is for steady growth over the next 5 years and the dividend in the future.
Thank you.
Just to follow up on this slide, and then you're referring to the growth and then the dividends that you're expecting. Based on everything you know and understand about this company, did you put a certain weight on each of these different methodologies based on that?
Correct. Yeah. So we applied 25% to the earnings multiple, 25 to the free cash flow, and 50 to the dividend, because we think the dividend is the most important part of Aflac, especially as they're going to become more of a dividend giant in the insurance industry. We thought that would be the most important way to use in valuing them.
Thank you.
I have a couple of questions. Can you go back to the slide that has the different valuation models on it?
Yes.
I think it was 23.
Oh, go back to that. Give me 1 second. Sorry.
No problem.
Here we are.
So this is a pretty big price range for the different valuation models. And so I'm curious how you feel like you can come up with a range of $37 to $118. If you feel like that's reasonable, or the assumptions are more or less valid in a particular model.
Yeah, no, I understand what you're saying. Yeah, so that's why we weighted it more heavily towards the dividend, because nobody's going to recommend that Aflac's going to be trading at $100 at the end of the year. So we weighted it heavily towards the dividend, and we wanted to incorporate the free cash flow a little bit. That's why we only gave it a 25% weight, because it is kind of out there a little bit.
Mm-hmm.
And we really do think the dividends are the most important part of why somebody should invest in Aflac right now. Obviously, it's a company that's been around for 60 years, so free cash flow is not the number one priority, but dividend growth is for a lot of investors. So that's why we do think it's reasonable, but that's why we weighted it more heavily towards the price target of $41 for the dividend.
Okay, thank you. And then it sounded like you're counting on Japan for growth in sort of the near to midterm, but which is a differentiated view, which is great. But given the declining population there and the tendency of the market to look forward, how do you see the sort of the long-term growth prospects?
We really do see a lot of growth in Japan. Yeah, even though, again, just like the US, they do have an aging population. They still are, their economy is growing a lot. And insurance is growing along with that. And then there's also the growth throughout Asia that spills over into Japan, especially obviously in China. China's seen a lot of insurance growth, and we could see that spill over into Japan as well. And then maybe one day they could even expand if they wanted to further into Asia, including getting into China.
Have they talked about getting into China at all?
Not specifically, but it's definitely a possibility. China's growing at about 20%. The insurance industry is. Obviously, everything in China is going crazy. So it's definitely an opportunity. But we haven't talked about it specifically.
Judges, we have time for one more question, please.
Well, with the low yields, low investment or low interest rates right now, low yields on bond investments, do you think that that puts the assumption that they'll be able to continue increasing their dividends at risk?
No, they aren't too concerned about it. Actually, we're obviously seeing yields rise quite a bit in the last few weeks. So things are starting to look up as far as that goes. But they do have a diverse investment portfolio. So they're not completely reliant on the yields going back up. So it obviously would help, but it's not the biggest concern right now.
All right, thank you very much. Team B, great presentation. Thank you so much. You are welcome to stick around in the main room and watch the final presentation. Please just turn your camera off. And judges, we will move you over to your breakout room so you can compile the scores, and we will resume in about 10 minutes. Thanks. I'm going to give you 10 minutes once you start speaking, and I'll give you a 1-minute verbal warning when you get down there, and then we will do a 10-minute Q&A with the judges after your presentation. So at your leisure, please begin, and good luck.
Perfect, thank you. Okay, I'm going to share, and then
Okay, hey everybody, we are Team J, and we are pitching Aflac Incorporated today as a hold recommendation. So for the executive summary, we have a current price of $45.31, a target price of $46.10, with a dividend yield of about 2.92%. And our 3 investment theses will be corporate growth strategy, fair multiples, and low interest rates.
So looking at Aflac's products, they have income loss protection products, supplemental medical products, and asset loss protection products. As far as their distribution network goes, they use independent brokers and agents to get their products out to customers. And then in Japan, they use postal offices and banks to distribute those products out to their customers. Looking at management, Daniel Amos has been there for 19 years. As far as the COO and CFO go, they are much newer to the team. Looking at the stock price chart, COVID-19 hit it hard. They had a 30% year-over-year drop in sales, and their top holders on the top right, Japan Post Holdings, their second top holder, that is the Japan Government Postal Service.
On the macroeconomic side, the biggest impact has been COVID-19 for sure. It has had negative impacts on almost every developed economy in the world. However, in the later half of 2020, we saw that many were rebounding. However, this was not shown in the US Life Insurers Index, which is one of the reasons we are continuing to have Aflac as a hold. We've also seen that declining birth rates pose a significant threat to insurers, especially in the Japan and US, where they have some of the lowest birth rates in the world. We predict that the global insurance provider market will reach around $3.6 trillion by 2022, driven by entry into new segments such as pet insurance, as well as the rise of artificial intelligence brokers through companies such as Lemonade, which will force many traditional companies to innovate technologically. And then we've also seen that low interest rates in the US and Japan have caused many insurance companies to take on riskier investments in search of greater yield.
Okay, so moving on to the Porter's 5 forces, just to touch on the main risk, we have the power of buyers as the highest risk. And these buyers have a bargaining power because there's so many players in the industry that Aflac will have to make sure they have the best product in the most cost-efficient way to stay competitive within the industry.
Yeah, so moving to the financial analysis, looking at the income statement, the first thing we want to point out is Aflac is a company headquartered in Columbus, Georgia, and reports in the US dollar, but actually 70% of their revenue is coming from Japan. And as far as their overall revenue breakdown, 85% of that is coming from premium revenue, and then the other 15% is coming from investment income. And our projections are seeing near-term pressure due largely to COVID-19. And like Jillian touched on earlier, the 30% drop year over year in sales reported as of Q3. And then their corporate growth strategy, where they're in the investment phase with a lot of projects that are looking at, and that's something we'll touch on later. And then moving to the balance sheet, so their total investments is the main way that they grow their asset base. And so with that, we see that being the main driver of their asset growth on the balance sheet moving forward. And then we feel that they have ample liquidity with their cash balance, as well as they have 2 revolving credit facilities with no current borrowings.
And then the main takeaway from the cash flow statement is the commitment to their dividend growth. This is the 38th consecutive year that they have increased that dividend, and they look to do that moving forward in the future. And then moving over to the valuation. So you can see the widest price range is going to be the 52-week high and low. And then as far as our kind of three-pronged approach for the valuation, you can see the DCF is the most optimistic with a middle target price of $51.94 a share. And that's based off a long-term growth rate of 0.5%. And then with the asset-based model, that gives a target price of $45.99 a share. And then for the comp values, again, that's something Preston will touch on later as well with the overall multiples. But we felt that a base case 10 times PE multiple was in line with our valuation objectives. And so overall, we saw a target price of $46.10 a share compared to the current price of $45.31. So that's roughly kind of a 2% premium to what they were trading at the time.
Looking at risk, first, Aflac as a supplemental insurance company is more vulnerable to low interest rates. When interest rates are so low, Aflac's ability to produce interest income is removed. To mitigate this risk, Aflac uses sophisticated interest rate hedge swaps. Second, for Aflac as an insurance company, the volatile economic conditions make Aflac's underwriting and actuarial forecasting difficult. Additionally, with the global pandemic, in-person sales meetings have been limited. Although Aflac may see this impact reduce going forward as workplaces get more accustomed to remote client meetings.
Yeah, and so specifically when you look at a company and 70% of their revenue is coming from a different currency, one of the first things that's going to come to mind is exchange rate risk. So we took some information disclosed in their annual reports and we're able to put together this graphic at the bottom. And you can see that if the yen were to strengthen or weaken compared to the US dollar, so say the yen were to strengthen against the US dollar by 10% every year of our projections, so from 2020 through 2025, annually, 10% appreciation. You can see that our DCF valuation would have only been changed by 6.6%, and our overall valuation would have only been changed by 3.9%. And the odds of this same 10% strengthening or weakening annually is extremely minuscule. And so we wanted to put this together to help mitigate that exchange rate risk and kind of show how we see this fitting into the overall picture of Aflac.
So looking at ESG, first we have environmental. On our right, we've got the Aflac US and Japan recycling rate. For US, it's 60%, Japan 65%. They're doing really well in comparison to their countries, which is 30% for US and 60% for Japan. On our left, we have Japan's and Aflac's US CO2 emissions reductions. These percentages are over a timeline from 2004. And then in 2019, they saved $18 million through energy conservation efforts. Looking at their social and governance initiatives, this page just shows some highlighted groups that they discuss as a part of their company, specifically looking at board of directors. They are 36% female. With Aflac overall, I think that they're struggling a little bit to get some of those females into some of the higher ranked, higher salary positions. Overall for ESG, they're pretty in line with their peers.
Okay, so now we're going to move into the three theses, and number one is going to be the corporate growth strategy. And so these are really just the four initiatives that Aflac is taking to grow their business. So first we have pet insurance. And so in 2020, Aflac entered into an exclusive alliance with Trupanion to sell their product. At the time, they also purchased a 9% stake in Trupanion. Also, they have the dental and vision and group life disability and absence management initiatives, with group life disability and absence management being the one they're projecting the most revenue growth from. And they're projecting 500 to 800 million over a 5 to 7 year time frame there. And then about dental and vision, they acquired Argus Holdings and its subsidiary Argus Dental and Vision, and that happened in 2019. And then lastly, they're investing in digital consumer markets. And so with COVID-19 sort of impacting the world and really just moving technology faster than ever, Aflac is forced to change with the times. And so they are implementing mobile technology, virtual enrollment, live chat on their website, and digital payment tools. So this is one of the main reasons why we're pitching Aflac as a whole, is because we do want to see where these growth initiatives go in a 2 to 3 year time horizon. And so thesis number two, we're going to touch on the fair multiples. So on the left, we look at Aflac and compared Aflac actually against itself. And so in the light blue, you can see the current, dark blue is the 2 year moving average, and the orange is the 5 year moving average of what Aflac has done historically. So if you look, Aflac is right in line with what they've done pretty much over the last 5 years. And then on the right side, you can see the MVE to book value. And outside of Progressive, Aflac is right in line with their peers. And so moving over to the next slide, we just sort of laid out these 4 graphs to show the different multiples that we valued Aflac with. So there's ROE, ROIC, EV to sales, and return on assets. And Aflac is the leader in EV to sales. And outside of that, we are viewing them as in line with peers.
1 minute remaining.
Thank you. And yeah, so lastly, the last thing we're going to talk about is low interest rates. So as touched on earlier, about 15% of their annual revenue is coming from investment income. And actually about 9% of their total fixed maturity securities are coming due within the next 5 years. So with the negative interest rate environment in Japan and with the US federal funds rate dropping from 175 bips to about 25 bips currently, we see them exposed to material reinvestment risk. And so this is definitely something we want to look at moving forward and see, are they able to obtain a similar yield to what they've had historically as these securities are maturing? And if so, are they going to be able to do that at a similar risk level that they have currently, or are they going to have to increase their risk level moving forward? And the last slide is just the timeline and catalyst. This is key events we've seen in the past that have affected the stock price, and then kind of the key events we're looking to in the next year to either maintain or change our hold rating. But as of now, based on our 3 main theses of corporate growth strategy, fair multiples, and the low interest rates, we are pitching Aflac Incorporated as a whole today.
Great presentation, team. Thank you very much. We will now turn it over to the judges panel for a 10-minute Q&A. Judges, you may begin. Thank you.
For your valuation, would you go over again the relative weightings that you put on each of the valuation methods that you used?
Yes, so we just used a third each. We felt it appropriate to split these evenly between the DCF, the comp-based model, and then the asset-based approach.
And then the 52-week high and lows just there for illustrative purposes?
Correct.
Okay.
What assumptions did you use in the DCF model?
Yes, so for the DCF model, and actually in the appendix, if you, could we scroll down a couple of slides? There, so that's the DCF. The shares outstanding was something we used from the annual reports. The free cash flow to equity pretty much just came from our overall income statement, our financial statement projections. And then as far as calculating the weighted out or the cost of equity for the model, can we go down one more slide? So you can see there, so actually since 70% of their revenue is coming from Japan and 30% from the US, and then actually their asset base is split with about 85% of their assets dedicated toward Japan and 15% towards the US. So we felt it necessary to come up with a cost of equity for the total firm. We wanted to come up with a cost of equity for the US and Japan and allocate that proportionally based on their weightings to come up with an overall firm cost of equity. And you can kind of see there the metrics we used. So those were kind of the main drivers. And then again, I think I touched on this, but we had a 0.5% long-term growth rate for the company.
Did you say 0.5%?
Yes, 0.5%.
Yeah, that's very helpful. What do you think their prospects are for being able to execute on their growth strategy?
Yeah, so we were a little bit conservative as far as our projections on their growth strategy. Some of those things, and like Preston talked about, a big reason we're pitching a hold. So if you think about the digital consumer markets with COVID, a big reason they gave for their 30% drop year over year in sales as of Q3 was the fact that they weren't able to meet in person with clients. And so with that, they're really trying to invest in this project. And with something like this, if you think about like Android versus Apple, we've seen historically that sometimes operating performance doesn't necessitate that something is the most successful in its space. So maybe Android has more capability, but Apple is more user-friendly. And so that's something we're not really sure, but moving forward, we want to see how do consumers respond to the digital consumer markets. And if that's a very positive reaction, if
pet insurance. If pet insurance seems to be a really big thing, they ran studies, and pet insurance was the #2 thing that clients were saying they wanted insurance in that wasn't already currently offered, as far as their dental and vision. So we want to really see these prospects moving forward, and maybe over the next year, kind of see how consumers respond to this before we would consider adjusting our overall rating on the company.
And if you look at our corporate growth strategy slide, we pulled the numbers from the financial analyst briefing that Aflac hosted in late 2020. And they actually did this at a 5 to 7 year projection period. So even Aflac as the company is projecting these growth strategies to be a little bit slower. So that's one of the reasons why we were a little bit more conservative with a hold, is because, you know, we're not going to say that these are going to happen in the next year or so, but we do want to see where they play out over the coming years.
That doesn't move the needle that much, does it? The company with total revenues of 22 billion.
No, you're correct. You're correct. So that's something where, again, like Preston just touched on, they're not really expecting to have a major impact, or they're not really expecting to have an impact at all other than just cost until maybe 2023, 2024, the back end of the projection period. We see in Japan, so if you look at the market, the cancer insurance has a much lower penetration than some of the other products like their life and health, which have a penetration of around 80% in that market, and cancer insurance only has a penetration of about 40% in that market. So we see them with a lot of opportunity there. And then in the US as well, they discussed in their investor day in November, but they see kind of low penetration in the US market as well. And that's really where they're pushing expansion. As I touched on earlier, a lot of their revenue and assets are coming from Japan, and they're looking to shift that more to be a more even balance in the long term between the US and Japan.
Thank you. I had another very quick question on ESG. How well does the company do communicating their ESG to people, since this is a consumer-oriented and customer-oriented company?
So first, I want to say that they just created this new website specifically for ESG, and they're kind of new as far as comparing them to peers. That's kind of a more innovative way that they sort of put out their ESG compared to peers. They created for the first time this year a new report specifically for ESG. A lot of companies have the corporate social responsibility reports, but they came out with sort of that similar corporate social responsibility report, but then also this specific ESG report. I will say they were very strong in highlighting, you know, some of these diversity groups and what they were doing in energy conservation, electricity and recycling and stuff. But some of the areas of growth they didn't highlight on that much. They had goals like in 2025, we'd love to be, you know, completely paperless or whatever they're working towards. But they communicated clearly in their ESG report what they've been working on and what they've done in the past.
Your bottom line was that they were in line with their peers?
Yes, they're pretty in line with peers.
Okay.
And yeah, as far as reading the corporate social responsibility reports for other companies and then reading their specific ESG report, they had a lot of similar stats there.
Okay, thanks.
So it looks like the CFO and COO are relatively new. Two questions there. Was there any significance to the recent turnover in those positions, and any ideas on succession planning for the company?
Yeah, so that's something that Daniel Amos, I believe he's in his later 60s. So that's something where we don't see him leaving in the extremely near future. And it's not something that we've read a lot about, honestly, in our research as far as his succession plan. So we didn't read anything. Nothing gave us, you know, kind of let alarms go off that this is a major material risk. But I mean, you could consider that there is key person risk with Daniel Amos. So again, something to look for in the future. But we didn't feel that it was a major risk when looking at this company.
So can we go for a second to the, I'm sorry. Can we go for a second to the growth strategy that you outlined? So when you were talking about growth strategy, it kind of sounded like you said that the reason why you have hold right now as the rating for the company is because of this growth strategies, and you want to see how they all turn out. Is it more of a hold with potential in the future to become a buy, or is it more of a hold to become a sell if the growth strategies don't work out?
So we sort of had it in mind as more of a hold to look towards a buy in the coming years, because we do think that these growth strategies are fairly good ones. But at the same time, we didn't want to be overly optimistic, since, like we said a little bit earlier, these growth strategies are over a little bit of a longer period. And so for this project, we sort of assumed a 3-year time horizon, 3 to 5 years. So we would be looking for a hold that could turn into a buy rather than a hold that could turn into a sell.
Okay, thank you.
Judges, we have time for 1 or 2 more questions.
May I just ask back on your evaluation slide, you said you used a third for the 3 different methodologies you chose. And I think you explained your DCF methodology, and that you're assuming a 0.5% growth rate because you're wanting to see proof of that actually occur. Just wondering if you would talk through the other 2 methodologies that you used and why you chose each of those based on management's capital allocation strategy or financial metrics or whatever, and why you believe the 1/3 allocation towards each makes sense.
Yeah, absolutely. So kind of, and to try and go through this really quickly, but for the asset-based model, we felt, because they have a lot of financial assets, we felt that made sense. And that was pretty straightforward, just equity divided by shareholders, or shares outstanding, excuse me. We didn't feel like a lot of their assets needed to be subtracted away from the total asset base with that. And then as far as the comp valuation, kind of what Preston was talking about earlier with the fair multiples, but we feel like if you look at what they've done historically, so if you look at where they're trading now, if we can go to the multiple slide, investment thesis 2. Okay, perfect. So right there. So if you one back. Okay, perfect. So if you look at the one on the right with the price to earnings, so they're trading about 9 times. Historically, over the last 2 years, they traded a little above 10 times, and then over the past 5 years, they traded between 10 and 11 times. And so for something like that, we've looked at them compared to their comps, where their comps trading at, and we got a median between 10 and 10.5 times for that multiple. And then looking at where they've traded historically, obviously COVID has been a crazy event and has changed the valuation moving forward. But we did feel that it was still appropriate to look at historical numbers. We think that it's not inaccurate to look at that and get a base moving forward. So we felt, based on where they're trading historically and where their comps are at, we felt that a 10 times multiple made a lot of sense for the base case, and then 8 times and 12 times as the bear case and the bull case. And honestly, just from those 3 things, we felt that all kind of looked at the company in different ways, focusing on different aspects. And with the comps focusing on where competitors at, with the asset base really focusing on the balance sheet, and the DCF really focusing on the income statement. So we felt that all 3 of these gave a unique perspective to the valuation of the company. So that's why we kind of want to allocate each one of them strategically with a 3rd representation of our overall valuation.
Thank you.
Great. Thank you so much. Great presentation, students. Thank you. And judges, thank you as well.
Thank you.
Thank you.
Yeah, thank you.
Thank
Thank you
you.
very much.
Thank you.
Thank you, students.
Thanks.
And so give us about 15 to 20 minutes to finish compiling these scores. And we will hear from our sponsor, Voya. We'll hear from the subject company, Aflac, and they'll tell you what they thought about your analysis of them. And we will reveal a competition winner. So I think it's been a very challenging year under the circumstances, the virtual program, but you guys, the students, have really come up big, and we're so proud of you and impressed by the presentations. So thank you for competing, and see you in about 20 minutes with the results.
Thank you. We enjoyed it.
So we're now entering the concluding portion of the competition. I think next is to hear from our subject company representatives. We have David Young and Daniel Bellware from Aflac. David, I'll pass it over to you if you want to say a few words, introduce yourself, and then I think after you, Chris Wilson from Voya will also say a few words before passing it back to me. So thanks so much, David and Daniel, for taking the time. I think I saw you listening in on the entire portion of the presentation. So really appreciate your time. And with that, go ahead.
Thank you, Charlie. Can you hear me okay? Great. Listen, I really appreciate it. You're right, Charlie. Given the nice virtual world that we live in now, I was able to listen in on all the presentations, and I really appreciated it. I'm David Young. I'm Vice President of Investor Relations for Aflac Incorporated. My colleague, Daniel Bellware, is on the line with me, and I'm calling in from my mobile office, as we say nowadays. And I really appreciate and want to thank the CFA Societies of Atlanta, Alabama, and South Carolina for the opportunity to be the subject company for this year's challenge. And also a special thanks to the CFA Society Atlanta, especially Kathy Ford and Aaron Zeta. You know, Kathy, aside from being a wonderful aficionado on smooth jazz, is also a pleasure to work with and was just a great guide for us to work through this process during an unusual time. And today's event shows all the hard work that Kathy, Aaron, and others have put into it, especially Charlie, and the host committee. Also want to thank the judges for, having this great event. It really does showcase the talent that is available here in the region, and I really have enjoyed listening to all the presentations. And on that note, I just want to thank all the participants. You did a tremendous job. I hope you found it as valuable as I did. It's always great to see the work that you do and see how others perceive it. And so you gave me a great window into how new eyes will look at Aflac Incorporated, and gave me some great ideas. And I really look forward to looking through the presentations again. And I just want to wish you all the best as you go forward, whether you go on to the next round or not. I think you've got very bright careers, either on the sell side or the buy side. I look forward to encountering you here in the future very soon. I'm sure I'll see many of you. And with that, I think I will hand it over to either Charlie or Chris.
Hey, David.
Hey.
Thanks, everybody. Again, congratulations to all the teams who presented today, and a big thank you to the advisors, our judges, as well as the countless volunteers across the 3 CFA societies who made today's research challenge a success. I'm Chris Wilson. I'm the chair of the programming committee for CFA Society Atlanta, as well as a senior fixed income client portfolio manager for Voya Investment Management. Voya Investment Management, we're part of Voya Financial. We're a Fortune 500 company, and we're flanked by 2 additional business segments. First, retirement services, perhaps our most visible segment, with Val and Vern, our orange squirrel and rabbit, who serve as mascots for Voya's 401k record-keeping business, as well as employee benefit services that includes offering stopgap coverages to various organizations. Now, Voya Investment Management, we oversee $255 billion in assets under management, with investment offices in Atlanta, New York, London, and Scottsdale, Arizona. And our fixed income platform, which myself, as well as Nicole, one of today's judges, our fixed income platform, we oversee $185 billion of those assets with over 200 fixed income professionals. Now, just like any other investment organization, our people are our most valuable asset. And we pride ourselves in the culture that we've built at Voya to attract and retain top talent. We've been voted one of the top places to work in investment management with pension and investments for 6 years in a row. And most recently, we were named to the Barron's 100 Most Sustainable Companies, placing 5th overall and the number one company in financial services. We are very proud to be part of the Atlanta investment community. And part of that commitment is reflected in our entry-level analyst, as well as our summer internship programs. COVID did not stop us in 2020, and it's not going to stop us in 2021. For those participants today, if you're college seniors and you're still in the middle of your career search, we do have opportunities specifically geared towards 2021 college graduates, and they're listed on our career website. Included is an opportunity actually right here in Atlanta as an entry-level position with our emerging market debt team. Now, for those of you not graduating this year, we are posting internships, and in fact, selfishly, my team is going to be posting our internship sometime next week with our client portfolio management team. And while the opportunity is Atlanta-based, living in Atlanta will not be required, as our 2021 internships will be 100% virtual. And so again, congratulations, great work to everybody. And let me hand it back over to Charlie.
Thank you so much, Chris. Really appreciate it. So I'm going to do a very brief presentation now. And then we'll do the fun part. We'll announce the winner. So as mentioned previously, this was really a partnership that came together between 3 CFA societies, Atlanta, Alabama, and South Carolina. You know, we've worked closely together for many years now, and the individuals listed on the slide had very time-consuming and important contributions to this research challenge. And I can assure you, behind the scenes, I know it took a lot of work to create the research reports and then conduct and create the presentations. And behind the scenes, it took a lot of work as well. So, you know, you've heard us thank especially Deborah and Kathy for kind of orchestrating this whole thing. You know, I want to recognize Aaron, my co-chair for this year's research challenge, as well as Hunter and Celia from the Atlanta Society, and then especially Trey Cartledge from Alabama and Joe Giltner from South Carolina. It's been a great partnership, and we really appreciate it. Just so you're aware, in case you aren't, there are a lot of resources that you, as a soon graduating college student, can get access to within the CFA candidate resources. And whether that means online mock exams, there are discounts for educational services such as Kaplan that you can get access to. Area candidates and CFA Society members are eligible for exam prep materials, and there's other free resources as well. And if you have any questions about any of the resources, obviously feel free to reach out to the Research Challenge inbox. We're happy to provide whatever information we can if you're interested in moving forward with the CFA exam process. And I do want to also mention, I think there's a deadline on this, but the CFA Institute is offering a discount regarding the sign-up fee for this year's CFA exams if you were a Research Challenge participant. So just keep that in mind. You all are likely aware, but the next step in this process for the winner of this competition is to move on to the Southeastern US Regional. That's actually a new level that the CFA Institute created this year. So you'll be competing against other competition winners from the Southeastern United States region. And then assuming you win that, you'll move on to the Americas semifinals, and then the Americas region finals, and of course the global final, if you make it that far, April 22nd of this year. Obviously, we are rooting for the team winner. Again, thank you to Chris as our Voya representative. Thanks to Refinitiv and Kaplan Schweizer as sponsors of this year's event. We heard from our friends at AFLAC, really appreciate the time they've committed to this effort and the dedication they've shown with answering questions and participating. Really appreciate that. Thank you to our judges. You all heard from them. Hopefully you could tell how qualified they were and how interested and passionate they are about this subject and their willingness to help out with this effort. Appreciate their time and their volunteering for this. You know, I think many of you, again, are aware of how the presentations were scored. The presentation rubric was a little bit different than the rubric for the research reports. But when it comes to looking at financial analysis, valuation, we talked a lot about ESG today, your overall presentation, et cetera, the judges follow this rubric very carefully to determine their final scores. And then lastly, I think before we announce the winner, I want to reveal, so far you all have been anonymous, but I want to reveal the actual team names or universities that correspond with each team letter. So we're really happy actually this year with the geographic diversity we achieved with our final 5, whether it was Anderson University from South Carolina, Auburn, Mercer, University of Alabama, and your University of Georgia. Really proud of all of you for making it this far. We really appreciate the faculty advisors and the mentors that have put in time to help out the students. And with that, I think I just want to say that, you know, this process is hard, and I think you all should take a lot of pride in making it this far. You know, we have had 16 graders review the reports overall that were submitted, and that was just in the first tier. And then we also had a tier 2 of graders that re-reviewed kind of the final allotment to determine the 5 that would go on to this competition. And then you had to create a presentation in a very detailed way. You had to answer very tough questions from very seasoned professionals in this investment space. And so I just want to say, I'm proud of you. All the individuals on the host committee are proud of you, and you should be proud of yourself because, you know, this was an extracurricular activity. There was a lot of work, and you all did a really good job. And I think you will take these skills forward with you, and they will be very valuable in your future endeavors. So thank you again for participating. And with that, I think we may just need a minute or two just to finalize the grading and to add the judges back in and announce the winner. So just give us one more minute or two and we'll be right with you.
Yeah, I'm going to share my screen here. So first of all, let me say thank you to the judges, the teams, the mentors, the faculty advisors, and of course the subject company AFLAC for all the time that you've spent and all the energy you've spent on this. I was just in the breakout room with the judges, and we had a very difficult decision to make because of tight scoring. But you know, in the end, I am very proud to announce the winner of this year's research challenge is, let's see, Mercer University. So congratulations to the team.
Bravo.
Team C. So again, thank you for, we will be, I guess, Kathy, do you mind to jump in here with the mechanics of next steps?
Sure, I'll be reaching out to your faculty advisor. First of all, congratulations, Mercer, and thanks to everyone who participated today. But we will definitely be, I'll reach out in regards to delivery of your prize money and also the Chalice Cup. We'll be getting that updated and expedited over to the university as soon as possible. So excited. And congratulations. I'd love everybody to unmute and let's do a little
Congratulations.
Good job.
Bravo.
Well done.
Very
Well done.
Everyone was very impressive today too.
Thank you,
You all
guys.
have very, very bright futures, regardless of whether you won today or weren't there. You all have incredibly bright futures. So very impressed.
I've been doing this for a number of years. These were some of the highest scores I've given all the teams. All of them did quite well.
Thank you. Thank you.
Yeah. Yeah, no, it was especially impressive across the board, given, at this point, we've all lost track of what reality feels like, but doing all this through Zoom and remotely and everything was really well done. And thank you, Kathy, and the CFA people as well for their part in doing that. It was all very well done.
I'd also like to say to congratulate all teams here just for making it to this point. From somewhat being involved with this, I know that there were a lot of teams that did not get to this point. They because of all the distractions, just the whole process of devoting that time to this, it was too much for them. So you guys just getting here was a big deal.
Yeah, you guys did a great job, and all the presentations were great and very impressive. So thank you so much, guys.
Thank you again. Thank you all again. Yes.
Thank you.
Welcome any additional feedback from our team or anyone else on the line here for Team Mercer.
I'll add that last night I sat down and read all 5 of their written reports, which obviously the judges had no access to, and they were stunning. I was just very impressed at the caliber of work that these teams have put forth. It's very reassuring. So thank each and every team.
One thing I'll add is that the judges did spend the time to provide some feedback, which we'll be able to share with the faculty advisors here shortly. So, regardless of how today turned out for you, I think that that's constructive criticism and feedback for all the teams.
And we welcome everybody to stick around if you'd like to network a bit. George H., do you have anything you'd like to say to your team?
Just to echo what everybody else said, that it was really well done by all those teams. And we just appreciate all the graders, all the judges. A lot of work went into this. And I think all the students really benefited from the experience. And so that's the bottom line, is to make it a great educational experience for them. And it took a lot of people to pull that off, and especially during the pandemic. So well done to everyone.
Sounds like AFLAC was very helpful too. They were cooperative.
Oh, yes. I'll say
That's
that.
great.
They even invited us to their investor call.
Right.
And Carol Shervin is on the line, who is our consultant. There you are, Carol. Feel free to say a few words to the winning team as well.
Yeah, congratulations to all you. Wonderful job, Mercer. And I look forward to working with you, to looking at your presentations and seeing how we can move forward from looking how you look and sound. So congratulations.
Well, congratulations, Mercer. I see Jeff out there, and several years ago, when I first got involved in the CFA Challenge. I was living down in Warner Robins, working in Macon, and Mercer was the first school that I mentored and worked closely with Jeff. So congratulations for hanging in there and making it this year.
Thank you, David.
I'm sure that Professor Jeff and John Wilson Gordon and the rest of the team would love to get any and all feedback so that we can try to, make it even better for the next round of competition. So we look forward to any suggestions you have.
When's the national competition?
I didn't see who the other teams were, what schools they were from. Could you show that again?
Team O was University of Alabama, who did an exceptional job. Team B, Anderson. Team H was University of Georgia. Team C, we just discussed. And then Team J, Auburn University.
Thank you.
I'd like to ask Team C whether there's a favorite watering hole in Macon that you might gather and celebrate this news today.
Yeah, we don't have a favorite. We'll go with anyone at this point.
I'm actually on my way to compete against JU in a lacrosse game, so I won't be able to participate with the group until I get back.
Good luck, Clay.
Good luck.
Yeah, no, we'll definitely be in touch with you about that watering hole. But I just wanted to reiterate that everyone did a really amazing job. I know we were very intimidated by the other teams, especially whoever the last one was, Team J. Definitely kind of had us biting our nails, but I think everyone did a great job. So I was personally back and forth at the end. So just thank you all so much. We're very grateful.
Like I said, you've all done a great job, and you're all raising the bar for our industry and everyone in it.
So for David Young and Daniel Bellware, you might be interested to know that when our team first got together back around Thanksgiving, I think Aflac was selling for about $34 a share. And I mentioned to the team that I thought it was a screaming buy. And, in the next, whatever it was, 3 months, obviously it moved up to 46, 47. And so we ended up with that hold recommendation, which I think did make sense. It was the consensus of the whole team. But I'm sure all of us wish we had bought it at 34 back in November.
Isn't that a common problem that you see a stock and think, oh, that's a great buy, and by the time you do the research, it's everyone else has figured it out as well?
Right.
And I assure you, we did notice.
Are all of the schools doing remote learning, or are there any in-class sessions right now with COVID?
So we're totally in person at Mercer. I can't speak for the other schools.
Yeah, at Mercer, we're doing all in-person classes. We have a lot of surveillance testing that we're doing, just getting randomly selected to get tested at Mercer Student Health Center. And honestly, they've done a very good job with making sure it's safe to come back. A lot of enforced protocols to make sure that we're distancing and wearing our masks. And whenever we want to get a test ourselves, not even when we're asked to, we can just go right to the Student Health Center and get it. And it's been a good experience getting back into the classroom safely.
Do they have like social distancing in the classrooms, or have they moved you into like larger size lecture halls to accommodate the social distancing?
Yeah, so they've spaced out everybody in those classrooms, and there's certain capacities that are placed on each classroom based on the most amount of people that can fit in there with those protocols. And I've had a couple of classes myself that had to move rooms as the semester progressed at the beginning, as people got added to the class to accommodate those distancing guidelines. But they're definitely prioritizing making sure that it's safe to get in this classroom rather than just trying to force us into those classrooms, and they've done a good job.
Yeah, that's impressive that they're able to successfully come back and keep it all under control. Congratulations.
And I have a research question for the teams still on the call, which is, does your school offer you any sort of, this is just so much work. I mean, it is really a heavy lift to do this. So as an offset to your other academic obligations or part-time jobs or whatever other challenges you're dealing with from a time management perspective, do your schools offer you any sort of college credit for participating, or what do you get out of it, I guess, directly?
At Mercer, we register into a 3 credit hour course for doing this competition that's titled CFA Research Challenge.
Oh, wow.
We get a 3 credit hour class to our name.
It becomes part of the electives for finance majors. So the 3-hour credit is part of the electives for the finance majors.
And I also want to add to that, granted, if it was a 3-hour course or a 0-hour course, this was one of the most meaningful courses that you could offer a finance student. And having the opportunity to network with my peers, with professionals, this really was just icing on the cake to have this opportunity to represent not only our business school, but Mercer University. It's not about us, it's about collectively the university, the professors that we've had over the last 3-4 years. This really speaks on behalf of Mercer University and where we're headed in the future. And we're glad to represent the 3 regions here for the CFA, ultimately to move on to the next stage.
Did your team come in second last year?
Yes, sir, we did.
Yeah, I thought so. Yeah, I mean, that obviously is paying off, actually having that class and getting the participation. And obviously it's led to a quality preparation program for this.
And Mr. David, you hit it on the nail, but that again speaks back to our professor, Dr. Jeff, Professor John Gordon, and also our mentor, George, and their guidance and support throughout this whole process. Without them, we would not be here today, and we would not have been able to accomplish what we did today.
And the scoring was extremely tight last year. There was just a hair's breadth between Kennesaw, who won, and Mercer. It was just like to the second decimal point. I mean, it was really tight.
You know, we were in contact with the Coca-Cola team throughout, and they gave us advice and, you know, just giving us helpful hints on how we should, prepare ourselves for, this process. And at Mercer, we're a smaller university. We're not a big state school, and that gives us an opportunity to really network with our peers and really have those beneficial relationships. And so, you can rely on them for any help in terms of giving us guidance, but also just telling us kind of what we should prepare ourselves for the next chapter in life after graduation.
Are you guys in graduate school or undergrad?
We are all undergrad students. I believe, to speak on behalf of everybody, I think we're all seniors as well.
Right.
Just to point out, the scores for last year are still engraved in my heart. That was 90.7 versus 90. So, so I wanted to make sure that we don't out 0.7.
I might volunteer to the judges and others that are still with us that when the team was first practicing going through the slides for the presentation, we timed it and it was 17 minutes. And then we did it again and we got it to 16. And, again, and maybe it was 15. And the last one that I saw was Thursday evening. They may have done more practice yesterday that I'm not aware of, which I think they did. I see some nodding heads there, but it was still like 11.5 minutes. And so I wasn't sure exactly what we would see this morning, but for the group to finish a little before 10 minutes, like 9.5 was just great. And so it's probably similar with all the other finalist teams, because you have so much that you want to say on all those slides. And that's why our appendix was like 65 pages long, just, to be ready for whatever questions.
there's an element of realism in that. I've had presentations where people said, you have 10 minutes to convince us.
Yeah, that is one of the hardest things to learn, because by the time you do all the research, you have so much you could say about the company. And everyone just has such short attention spans nowadays and is under so much pressure. So yeah, that's definitely a skill, a valuable skill to pick up.
Well, again, congratulations to everybody. This was just, and I'm so glad that it worked out for Mercer this year. You guys have been strong competitors for a long time, so it's greatly appreciated.
Thank you so much. And thank you to all the hosts as well as sponsors. And thank you to the judges as well. We can't express our gratitude enough. This is a fantastic experience for everyone involved. We're so thankful to be able to be a part of it.
And this year, you don't have to turn around and drive back home.
That's exactly right.
Missing that in-person element, but it's certainly more convenient.
Well, it's and not on short notice, but to have the adjustments and have things run so smoothly. You guys just did an amazing job, which we fully expected, but I want to commend you on that as well.
Yeah, 3 cheers for Kathy and Deborah. We simply could not have pulled this off without them. They made it all happen.
Thank you. It was a team effort though. Thanks everybody. Again, so proud of you guys for coming back and taking the cup home. Great job.
Thank you.
Well, y'all can stick around or not. I just want to say enjoy your weekend and take good care. You made Mercer proud today.
Thank you so much.
Thanks, everyone.
Thank you. Go Bears.
Have a great weekend.
so much.
Congratulations again.
Have a good one.
Thanks, everybody.
Here.
Thank you.
To the future. Bye-bye.